The management were really upset, and they called this same guy, the same KGB guy who was on the board, and said, go find out what happened and fix this problem. We had a meeting with them to talk about either them buying us out or us buying them out. And they sent a guy who showed up with a white butcher's jacket covered in animal blood. But a lot of the lower level organized crime folks were still there and still operated, and still operate today. So it wasn't just Gazprom. The entire Russian stock market was valued at 1% to 2% of what it would have been trading if it were trading on a US or a European exchange. We have a big long position in the Japanese stock market. We're short the S&P 500 against that. So it's really, the bet is that the Japanese market outperforms the US.
I love the history of financial markets. And being born in the USSR, I was acutely aware of Russian privatization of 1990s. A phenomenon that, in my opinion, every investor should study closely. So when a friend sent me a book, The Siberia Job by Josh Haven, I got intrigued. I don't read fiction much, but because the book was based on a real story, I gave it a try. I freaking loved it. It's a combination of The Big Short and the Guy Ritchie types of movies. And the craziest thing, these events actually happened. So for this episode, I interviewed John Kleinheinz, the famed investor and philanthropist on whom this book was based on. I'm sure the intro gave you an idea of what we discussed. So without further ado, actually, don't forget to subscribe. And now, John Kleinheinz. I have a book in my hand that was written, my understanding is based on your story, and it's wild. I want to discuss it because it talks about the Russian privatization and what you and your partner done there. So let me start with this. What's privatization, and how was Russian privatization back in the 90s was different from the similar things in Eastern Europe?
So privatization is any time that a government-owned asset is sold or transferred to the private sector. And it can take many different forms. I mean, the Maggie Thatcher government in the UK privatized British Steel and British Gas and British Telecom. In Russia, it was quite a bit different because remember, Russia was, when the Berlin Wall fell in '89, Russia's command economy went into a tailspin. And remember, it was a planned economy that they tell all the factories how much equipment and things to make, and then the people would be allocated food and goods and things, and often those factories just ended up with a bunch of products that nobody wanted, and the economy went into free fall. By 1992, the EBRD and the World Bank had taken some steps and some actions and provided funds to Russia. And you could kind of see the green shoots of the free market starting to appear. And it sort of took the form of what was sort of beforehand a black market where you could get whatever you wanted with cash. The factories were retooling and starting to make things that people wanted and things that they could sell overseas. And the EBRD and the IMF took it one step further, and they went to Russia and said, we want you to privatize. And here's a program we have, a voucher auction program that we've used successfully in Poland and in Hungary and the Czech Republic, to transfer all those state assets. So in 1994, they issued vouchers to all Russian citizens and did voucher auctions for pretty much 90% of Russian industry.
How did those vouchers work?
So they just issued them to people, and any Russian citizen could take their voucher and they could sell it on a street corner. They could put it into a voucher auction, and they would get a share of that company from that voucher auction. Now, what happened in reality is most of those vouchers were sold, and they were accumulated by investors like our fund and put into these voucher auctions.
How did you find out about this opportunity in general? Because Russia wasn't that open country yet, right? It happened just shortly after the Soviet Union fell apart.
People were talking about it. I mean, there were a number of folks who were talking about it, and one of the things I've learned in my investment career at Adnar is people get excited about the prospect of making money. Once they're actually making money, they get very serious and dour, but the prospect of actually making the money gets people excited, and people were very excited about Russia. I'd been there in '92, And it was a completely different place. There were no goods on the shelves. There were no cars on the streets. The only action that we saw was at the McDonald's on Tverskaya Street, where people would pay a month's wages for a kid's Happy Meal. And then, it was a bleak environment. And then I showed up again in early 94 and everybody had a deal. The streets were crowded. People were walking quickly, taking meetings. It was a different atmosphere. You could feel it.
Even in the book, it talks about Russia still was perceived as a Wild West, right?
Yeah.
What gave you confidence that you actually can go there and come back with a bunch of money unhurt?
So one of the things is that this voucher auction program had been done successfully in the Czech Republic and Hungary and Poland. And my partner in the book, the Peter Kellner and Peter Faligi, made a very strong case that it was going to play out the same way that it had played out. The big difference, by the way, in Russia and those countries is were the size of the companies. I mean, in Russia is so much bigger than all those other markets. So the phone company, served 100 million people and had cell phone subsidiaries. The oil companies were their big four regional oil companies. There was one big national gas company, Gazprom. The fertilizer companies, the steel companies, they were all just ginormous businesses. So we were just betting that the process of a stock market getting established would happen, and we were betting on the process, not anything else. And the process had already been successful in the Czech Republic and Poland and Hungary.
And how did you meet Peters?
So I was introduced to Peter in the Czech Republic. A colleague of mine from Merrill Lynch I told him I was working on the Russian privatization and wanted to work with some people. And he said, look, I've got just the guy you need to meet. He's an honest guy. He's done this before.
Peter Kellner then, he was already successful there, and he became very successful on his own in Czech Republic.
That's right. He ran one of the original voucher funds in the Czech Republic and was very successful before we all went to Russia.
What was your first deal in Russia? What was the first company you guys tried to get vouchers for?
The first thing we bought were the vouchers, and we submitted them in a number of deals, including Gazprom and UES and Rostelecom. The first stock that we actually bought was Lukoil. Lukoil became tradable because some of the management team were selling shares, and we were able to go in and buy those shares. We liked Lukoil. It was the holding company. You never wanted to own a subsidiary company in Russia because the holding company would strip assets and strip profitability, and the subsidiaries were never really valuable. The value sort of accrued to the top of the chain. So Lukoil is a great company. It was run by Vagit Alexberov, who had been Minister of Finance. He was very close to our friends at Akin Gump. Akin Gump was the first U.S. law firm to really establish a presence in Russia. And we knew from our conversations with Akin Gump that Lukoil was determined to become a Western-style oil company. And we were buying shares at roughly a $300 to $400 million market cap. I think Lukoil, when it stopped trading right after the invasion of the Ukraine, had a $60 billion market cap. So they were largely successful in that effort.
One of the staggering thing about that time is the valuation of the companies that were privatized. Like, what was the Gazprom's valuation? Tell the story behind it. How did you guys get the significant portion of the vouchers and how you were able to exchange them later on?
It wasn't just Gazprom. The entire Russian stock market was valued at 1% to 2% of what it would have been trading if it were trading on a US or a European exchange. That discount was somewhat justified. None of these companies had any working capital. They had all these social obligations for their workers, housing, food, education. So they were in a tough place, but you don't have to make a lot of progress to go from 1% to 2% of ultimate valuation to get to 5 or 6%. When something goes from a 99% discount to a 95% discount, it's gone up 5 times in value already. So all we were hoping was that they made a little bit of progress. The story of the Gazprom privatization was unique because most foreigners could not invest in the Gazprom privatization, and they made it difficult. And actually, there was a law against foreigners investing in it. And so we were able to, with the help of some folks at the company at Gazprom, who we knew and who we were helping and advising, we were able to get information on where those voucher auctions were, and we were able to travel to those regions and submit our vouchers in those auctions, whereas a lot of other, or very few other international investors were able to do that. And then we had a legal mechanism which allowed us to get around the rules against foreign investors, in that we had set up a company in Cyprus that was not did not have to comply with the rules under Russian law. And then we had the vouchers submitted by local people in those regions, and then we lent them money, and they defaulted on those loans, and we were able to take the voucher receipts as the underlying collateral for our loans. And so Russian bankruptcy law took precedent over Russian security law. So, I mean, and this is stuff that we didn't put in the book. It was too complicated, and it wouldn't have been interesting for the reader. But there was a lot of strategy and legal mechanics behind how we did this transaction.
And those auctions, it sounds like they were deliberately placed in some remote parts of Russia to make sure that no one really shows up for the auction except of management of the companies. Is it fair?
You stated it exactly correctly.
What was the most obscure place you traveled to?
I think the most obscure auction was where most of Gazprom's assets are, which is in the Yamal prefecture in the north. It's probably 400 or 500 miles inside the Arctic Circle, northeast of Moscow. So very, very difficult place to get to, and the home of Gazprom's largest LNG facilities and largest gas fields.
And I think managements went that far that they actually put tanks on the roads to make sure nobody passes through.
That was not true. That's one of the parts of fiction. It is true that did happen with another company that we were involved in, but it did not happen with respect to Gazprom. Yeah. I personally never climbed into a Russian tank during any of my travels outside of Moscow. The book is slightly fictionalized, but I think it's good that we did it. First of all, that all of this happened 30 years ago, and it's tough to remember exactly the sequence of events and all the people that are involved. And by using fiction, we don't have to get everything just right. And my co-author on Josh, I think, did a wonderful job keeping the story interesting by adding these slightly fictionalized parts of the basic storyline, which is true.
When you accumulated significant percent of ownership of Gazprom, what happened next?
We had a guy on the board who was advising us on how and when these auctions were taking place. When the management of Gazprom found out how much stock we actually got, and we ended up getting quite a bit more stock than we had anticipated getting in the first place. The management were really upset, and they called this same guy, the same KGB guy who was on the board, and said, go find out what happened and fix this problem. So that our guy, who had been our friend and our helper on this deal, all of a sudden became the guy who was in charge of getting all of the stock back. What ensued was a number of months of very intense negotiations. Ultimately, we reached an agreement with Gazprom and the management, and we allocated a percent of the shares back to them, and they gave us GDRs, which were freely tradable in the London market, and we were able to sell those shares.
If you didn't sell the shares at that period of time and hold on to it for, let's say, 10, 15 years, what would be the difference?
I think we bought the shares in rough terms for I think 25 cents each. We did a small private placement with a large investment firm in Los Angeles named Capital, I think at $3 or $4. And then we sold shares, Merrill Lynch sold shares in the Russian market for $7 or $8 a share. And that was the bulk of our share sales were done there. Ultimately, the stock went to $40 a share. By selling out quickly, we left an awful lot of money on the table.
Yeah, but you still made a lot of money.
Yeah.
That Russian fund that you started back in the day with
the Russia Value Fund. Yeah.
Yeah, with Peter, right? They were with you then.
So they were not part of that. I did that with my partner in Texas, and that's kind of an interesting story how the Russia Value Fund set up. We had my partner and I had a general emerging markets fund that we were investing in Russia in early '94 with, and we put about between $15 and $20 million to work in the Russian voucher auctions in early '94. Those positions went up roughly 10 times. So if you can imagine, we had a relatively small fund, maybe a $60 or $70 million fund, and all of a sudden 20 to 25% of that fund went up 10x. So our little global emerging markets fund was all of a sudden 80% Russia. And by the way, it was not such a bad thing because everybody was trying to buy Russian shares and they were worried about custody and did you really have ownership? And we had custody and ownership of these things. So rather than selling down our positions, which were still incredibly undervalued, we took all of that stock that was in our global fund, or we took most of it, 80% of it, and we moved it over to a new company called the Russia Value Fund. And that's how we started it. And then we raised money. People were very interested in investing with us in that fund because we had custody and we had the right stocks. And so we raised money and in there. So we actually created a whole new Russia business out of that investment that we did in the voucher auctions earlier in the year.
And I read that John Templeton was one of your investors.
Mm-hmm.
How did you get him?
We knew one of John's advisors. We knew Sir John. We knew he wanted to invest in Russia, and he called us and just talked to us a little bit about what we were doing and how we were doing it, and looked at our offering documents for the Russia Value Fund, and ultimately invested a fair bit of money in the fund.
And how long did that fund exist? And I'm guessing that fund was already invested in Russian equities, right? Not just vouchers.
Yes. That fund did not participate in the voucher auctions. That fund started in probably September 1994. So my partner and I separated in 1996. The Russia part of our business had gotten so big that it became somewhat difficult for I owned 25% of the company, he owned 75% of the company. It wasn't our working relationship had deteriorated because I was running the larger part of the business, and he started to get involved, and there really wasn't room for two of us to run the business. So I left and I started my own fund in '96. What happened to the Russia Value Fund and the original Emerging Market Fund is that they had the same positions on in Russia that long-term capital management had. They owned Russian treasury bills, what they call the GKOs, and with the foreign exchange contracts with Russian banks, Russia defaulted on those GKO bonds, and the Russian banks all went bust in 1998. And my partner and the Russia fund were put out of business at that time. I had left 3 years earlier, and I was running a global fund and was largely out of Russia then. So we actually had a pretty good year in 1998, and we're up a little bit that year.
This was a Global Undervalued Fund?
That's right, the Global Undervalued Securities Fund.
Your investment in Russia basically ended in around '96. But what was your life in Russia like? Just walk me through day to day. What do you remember? What did you like? What you didn't like? What was most staggering for you as a foreigner?
While I was in Russia, I developed a strong aversion to hotel rooms. I lived in hotels while I was there, and I'd often spend 3 or 4 weeks straight in hotels. And to this day, when I check into a hotel, I have an aversion to being in hotel rooms. But Russia was fun. You'd get up, you wouldn't start your day till about 10:30 or 11 in the morning, and you'd start having your meetings, and you'd meet all day, and you'd visit companies, and you'd visit brokerage companies, and you'd end up at night, and usually one of the fun night spots that we write about in our book. My friend Bernie Sucher had a number of restaurants, including Uncle Gilly's, where a lot of the foreign investors would turn up. It was just sort of a nonstop kind of conveyor belt, and I always tried to get out of Russia during the weekends, fly back to Prague or fly back to London. I was commuting from DFW, so I was often flying back and forth from DFW. But there was just a real excitement about the whole investment because Russia, it seemed like they wanted to follow the free market principles and establish the economic system that we had in the West, and you could just feel how excited everybody was to invest in Russia and be there. And new people were showing up all the time, and brokerage companies were opening offices and transferring people in, and it was just so exciting during that period. I can't even describe the kind of the visceral feeling of being in Moscow at the time, where just everybody had money to invest. Everybody wanted to do a deal. Everybody wanted to start something. It was like Moscow was the center of the universe in the mid-90s, in my mind.
I was very young, but I remember that period as a rise of organized crime as well. How was this organized crime and this much money in Moscow coexisted? Like, was it like commingling of people with like weird personalities, or what was there going on?
That's an excellent question. And you have to remember that when Russia was a command economy, the black market was really the only functional part of the economy. If you had cash, you could get whatever you needed. So when Russia transformed into a free market economy, or began that transformation process in 92, 93, and 94, it was a lot of the black market people that were most adept at organizing themselves and running these businesses and investing. So you had a lot of people who kind of moved from the organized crime side into legitimate businesses. I mean, I remember Menatep Bank, for instance, which was run by Mikhail Khodorkovsky. When I was there early on, I sort of viewed them as part of the mafia. I mean, we had a big investment in a company we talk about in the book called Babayev Chocolate, and they had accumulated a lot of stock. We had accumulated a lot of stock. They wanted our shares, and I remember once we had a meeting with them to talk about either them buying us out or us buying them out. And they sent a guy who showed up with a white butcher's jacket covered in animal blood. So now ultimately, Menatep Bank, got control of Yugos Nefty Gas and started Yukos and became part of the process. But a lot of the lower level organized crime folks were still there and still operated and still operate today. So it's a complicated question. I mean, we also had a company called Kirsch Tobacco that we actually just had to give the keys back to the mafia. We couldn't, we were so excited we got in control of this company, and then we found out, we may own the company, but they weren't going to let us manage it, and they weren't going to let us take any product or take any money from the company. And so we literally just sort of gave the keys back to them.
Were there like a direct threats, or it's more of the hints that something might happen?
That's a tough question. I mean, we were always insulated. I didn't ever deal directly with people that I thought were part of the mafia, but we would hear about them, and there were never direct threats. There are always implied threats. The Russians are very adept at implying physical harm, but the reality is that rarely happens. I mean, if you look back over a period of time, very few Americans have ever been killed in Russia. I mean, I think the number is like 5 or 6 people, and they're relatively isolated and idiosyncratic events. It's rare that they would actually target a foreign investor and do harm.
In the book, it says that there is one instance where there is mafia boss thought these vouchers are just garbage. It's useless. In reality, was it the same? Were they completely ignoring it?
I would say that the mafia largely ignored the stock market. The mafia in Russia, as I understand it, and I don't have a real good understanding of it, but my understanding is that they focus on cash businesses. Mm-hmm. And they exercise control at what I would call the factory gate. So they take their cut of goods coming out of mm-hmm. the factory and then sell those in the cash markets. But they're not involved as you move up the corporate chains. They're not really all that involved.
Right. Let's switch from Russia. You still run money, but for now you run your own fund without outside investors.
That's correct.
What's your investment style, if you can describe it?
I would characterize it as a value investing shop where we still run the Global Undervalued Securities Fund. It's the same fund that we've always had. We just don't have any. We only have one investor in it now. We have a much smaller team, but we look for situations where there's just deep value where for whatever reason the markets have ignored or haven't considered the value proposition. Right now we have a portfolio of number of things, but one of the things that we have in it is a number of beaten up biotech companies. COVID really hurt the biotech industry. It lengthened the study times that these companies had to run their studies. It distracted the FDA, and a lot of these stocks, are trading at under cash value. And a number of these stocks have products that are, there is a process. It's a very long and bureaucratic process, but there is a process for approving drugs. And a number of these companies are very close to the end of that process and will have drugs. And you can buy these companies for 1 times their revenue from these drugs a year or two out, and which is a very, very low valuation. So we have trades on like that. We have trades on in the energy business. I think there's very little capital going into energy right now, so the returns are very, very good. You can make excellent returns funding drilling programs. I think buying energy stocks is not such a good way to put your money to work, just because the investor base just isn't buying. At the end of the day, you need someone to come out and pay a higher price for your stock. And with investors staying away because of ESG from the stocks, they're not paying up for those stocks. But if you get very close to the cash flows are very good. So that's why these drilling deals and royalty deals are very attractive. For the first time in a long time, we have a big bet on in Japan. The Japanese stock market looks very interesting to us. Japanese companies have bought back a lot of stock. They've restructured. I don't think the Japanese government is going to be able to raise interest rates all that much. They've talked about, interest rates have been at 0 in Japan, and they've had yield curve control in Japan for 10 years. The U.S. was very, very quick to raise interest rates to combat inflation. Japan, I think, is much more reluctant to do that. And as a consequence, we think the yield on Japanese bonds is going to stay low, and it's going to force money into the stock market. And you're seeing the Japanese stock market break out to 30-year highs right now for the first time. And Warren Buffett was over there about a month ago, and he said the same thing. He said this is a very cheap market, very attractive market, and I think for the first time in a long time you can allocate to Japan.
Yeah, there is a lot uncovering what you said. Let's go back to, you said you value investing, and you mean Ben Graham type of value investing, right?
Well, I mean, it's Ben Graham invested in a different era with different types of companies. I mean, I don't think there were biotech companies when Ben Graham was investing, but yeah, I mean, value investing is you're buying things that really nobody's paying attention to.
But biotech is something that value investors historically avoided because of lack of revenue. So I'm kind of trying to reconcile in my head, but seems like you found a way to value them.
Well, I mean, I don't want to name names of specific companies, but we've been buying stocks that are down 80 or 90%. And, they've released results from studies that suggest that their drugs are going to be approved and they're going to have revenues of equal to their market cap, within a year. So, you're not valuing based on asset value, you're valuing based on expected sales and margins. But that's a very cheap stock. I mean, we're buying, typically these companies trade at, 3 to 4 times revenue. So it's a value trade as far as I'm concerned, and nobody, people aren't dinging around. I mean, if as a retail investor, we have a little bit of this trade on, I would just buy the ETF that has about 200 to 300 of these stocks in it. I think the ticker symbol is XBI. There's a number of stocks in there, but what really is going to make this strategy work is that the big pharma companies have needs and want these stocks in their pipeline, and they have a lot of money. And, for the last 4 or 5 months, almost every week you've seen a big pharma take out one of these small biotechs, and there's a lot more of that to go. So that's the catalyst. You always look for a catalyst in these things, and the takeout from the big pharma is the catalyst here.
Historically, you were both going long and short in stocks. Do you still short?
Yeah, we still run a short book. We don't do as much company specific work on the short side. We don't,
Okay.
target. We don't do as much fundamental research. We tend to use ETFs for the shorts.
And
We do from time to time pick individual stocks, but it just takes a lot of time.
so those ETFs, and it's more of the top-down approach. You're looking at some trend that you think can reverse, or you're basically just hedging what you currently have in your loan.
Both. We expect to make money. We put hedges on. We expect to make money on it, but they're also hedging long positions. For instance, I mentioned that we have a big long position in the Japanese stock market. We're short the S&P 500 against that. So it's really the bet is that the Japanese market outperforms the U.S. and that trade has gone very well so far this year. I expect that trade to work at least another year and maybe longer.
When you ran the fund with the outside investors, was your exposure to long and short the same, or has anything changed, or you pretty much have the same strategy?
We generally ran a strategy that was about 50 to 70% net long, and we might be 120 to 150% long and be anywhere from 60 to 70% short. Now it's a little bit different. I don't pay quite as much attention to risk management and volatility. My fund's a lot more volatile now that I don't have outside investors. I use outside managers too. I've seeded a number of hedge funds and have big investments in a number of hedge funds. So we use outside funds. We also, just over the course of time, I've accumulated a lot of real estate assets. I think I mentioned to you, I've been involved in a project to build a high-speed train from Dallas to Houston. And part of that has involved acquiring assets, real estate assets. Basically the train stations in Dallas and Houston are the principal real estate assets. So our book does not look the same as the hedge fund that I ran 10 years ago.
How do you find the opportunities? And when you find something interesting, what's your investment process like from that moment?
When I ran money for outside investors, the process was fairly regimented, and we had committee meetings and we write investment memos, and we looked at it in a pretty structured way. It's much less formal now, but the basics are still the same. I look for a macro strategy that works, and look for a set of economic conditions, whether it's growth or recession or whatever. And then the security selection part of it has to make sense within those macroeconomic assumptions. So, for instance, the Japan trade that I talked about earlier, Japan won't really be able to raise interest rates. Interest rates have been at zero for a long time, and banks have gotten used to that, and the system relies on these low-cost loans. That means that the currency in Japan will weaken because there's a huge interest rate differential between interest rates in Europe and the U.S. and Japan, and with a weaker currency, earnings are stronger, export earnings are stronger, and that'll drive the stock market, which is trading at 11 or 12 times earnings. So, we look for stocks in Japan that are exposed to that, mainly exporters, high value added exporters, but it has to, the stock selection has to fit within our macro view of the world.
And how do you size the positions?
That's a good question. I often have to contain my excitement because when I think I'm going to make a lot of money on something, I tend to put the positions on in really big size. So it's difficult for me to talk about, but it's not unusual for us when we really like a trade to have that trade on at 100% of our capital, to put an overlay on the fund that would equal 100% of the equity in the fund. Now that's a large size trade, but it's not unusual for us to do that.
Wait. You mean you can say it again? You can put the entire fund in one stock?
Not in one stock, in one trade. And so if, for instance, we think the Japanese market is going to outperform the S&P, and we were running $10, we could put that trade on in $10 long Nikkei and $10 short the S&P.
Oh, gotcha. Okay, that makes sense.
Now there are people I know who can put trades on at 3 or 4 to 1. I think that's a dangerous way to run money.
And has that changed as well as you stopped managing outside money?
I think I tend to trade in bigger size now that I'm managing my own money, and I also tend to let my winners run, and a lot of that has to do with taxes. We bought all these LNG producers 10, 15 years ago, number of LNG producers have made a lot of money in companies like Cheniere Partners, and when you have big positions like that, if you sell them, you have to pay a lot of taxes. So the tendency is to let your positions run. I think you can't do that when you're managing outside money because you have to worry about volatility. But my tendency is to hold on to these positions longer.
Back when you return money to investors, I read the memo. I think you generated north of 21% annualized, which is insane. I don't know. I think Buffett has the same return over his 50 years. The strategy that you're applying now, do you think if you were using the same strategy back then, you think the return would be even better?
Oh, it's hard to say. I mean, it's more difficult. I'm 61 years old today. You really have to work hard to get exposure to the ideas. It's just much more difficult as you spend more time with your family. And I have grandkids, and I travel a lot. I do a lot of stuff at Stanford University. I do a lot of work out there. So it's hard to say what the returns would be like. I do know that someone like Warren Buffett has a really neat business model because he owns so many private companies, and he can talk to all those managers. And he literally has a window into so many segments of the economy and industry from those managers. He's just got a great seat from which to invest in public markets, and it's a unique seat. And I don't have that, so it's hard for me to find these ideas, or harder for me to find these ideas.
But you clearly also focused on in segments or markets where you have experience, like circle of competence. Like you spent some time in Japan early in your career. Right. So you were in Japan when that bubble burst, right?
I was in Japan. I worked in Japan for 2 years with Nomura Securities right after college. So I was in Japan really in 84, 85, and part of 86. And I was still involved with the Japanese business later in the 80s when the bubble burst. We were helping U.S. companies sell assets they had in Japan. I was an investment banker, and we'd go to companies like, Northwest Airlines had an office building in Tokyo that was worth more than the entire market cap of the company. And Brunswick had all these bowling lanes, and McGraw-Hill owned a Japanese version of Business Week. And those were all assets that were, you could monetize for huge numbers because of the valuations in the Japanese stock market. It was bubble times. I think when I got to work in Japan, the Nikkei was at 5,000. And by the end of the decade in 89, it was at 39,000. So it had gone up 8 times. And it was a combination of a stock market bubble and a real estate bubble at the same time. And they were both feeding on each other. You just have to realize when bubbles are occurring and make sure you don't, get blood splatter all over you when they pop.
And so when a bubble popped, then Japanese equities been in trenches for how long? For until 2010 or something, right? It's been a long time. They couldn't recover. What was the reason for that?
It's hard to say. And there were periods of recovery in there. You had periods of outperformance, but really you had a series of events in Japan. You had demographic problems. You had deflation set in. You had these companies and these banks who had to work through all of the bad loans and restructure their businesses and sell off the bad loans. And the Japanese may not have done that with the same amount of aggressiveness as that would have been done in the U.S. The Japanese, just culturally, I don't think they want to work through things. They'd rather let time do the work. So I don't know the answer to why it's taken so long, but beginning in after the great financial crisis, the Japanese stock market's done great. It's done well. The Japanese government now owns about 8% of the stock market, and one of the reasons I feel so confident about buying the stock market is it's cheap, and I know that if it goes down a lot, I think the Japanese government will step in and buy the stock market as they have been over the last 5 or 6 years.
I've read that historically the corporate governance in Japan was not as transparent as in the United States. Did you observe that as well, or not necessarily?
I think it varies company by company. There are certainly companies in Japan that could do much better in terms of transparency, and certainly do much better in terms of looking after the rights of shareholders. I mean, a lot of companies in Japan sit on enormous amounts of cash, and in the U.S., that just wouldn't happen. People would put pressure on them to return the cash, do buybacks, do dividends. But generally speaking, the companies in Japan are doing much better. The Tokyo Stock Exchange have laid down rules for good corporate governance and expectations on how return on equity should work for Japanese companies, and they've largely followed that guidance. And Japanese companies have bought back more stock every year over the last 5 or 6 years than ever before. So I think there's a mildly positive trend in corporate governance in Japan.
You mentioned also that you invest at Texas Central, right? The railroad. Can you speak a little bit about that? Is it primarily a commercial project, or it's just your desire to improve infrastructure? What drives that?
So this is a project I've been involved in for about 9 years, and I was approached by a group that was working with the largest rail operator in Japan, a company called Japan Central, which operates the Tokyo to Nagoya, Kyoto Shinkansen. And this is a big company. It's a $40 billion publicly traded company. And they had done a study, and they had identified the best routes for high-speed rail in the U.S. They looked at 50 different city pairs, and they had concluded that Dallas to Houston is the single best route for high-speed rail in America because it's so flat. It's the right length. It's about 255 miles. Both Dallas and Houston are in the top 5 cities in terms of size in the U.S. They're the 2 fastest growing cities in the United States over the last 20 years. People go back and forth all the time. So it was just identified as a route. So we were partnered with the Japanese government to develop that project and to submit the engineering work and get the permits to determine the right of way. So we identified the alignment and submitted all of our permits. And after 7 years, we were given a record of decision. So the route has been finalized. The station sites have been finalized.
Nice.
All the safety permits have been given, and we're in just the administration is in discussions pretty much as we speak with the Japanese about how to move that project forward and build it with Japanese technology.
Is it expensive to build 255 miles of rail?
It's a lot more expensive today than it was when we started on this project 9 years ago.
Interesting.
The answer to your question is yes, it's expensive. But it's expensive to build, but this is the train is very inexpensive to run. Trains run on electricity. It's a relatively efficient form of transportation once it's built. It's expensive to build, but once it's built, it's incredibly efficient. It saves lives too. I mean, the freeway between Dallas and Houston, I-45, is the second most deadly highway in America. So the Department of Transportation in DC has done a study which suggests that up to 60 people a year will not die because of this high-speed train. So the train itself that we're using is a Japanese train that has a perfect safety record. There have been no fatalities in 55 years on the Japanese Shinkansen. The trains have literally never crashed. They've never had a crash.
And I'm sure there's also benefit of the commute, right? It's probably going to be faster to get from Houston to Dallas on this train, or not?
Oh yeah. It'll be 70 minutes. I mean, it'll be almost 2 hours shorter than flying by the time you factor in going to the airport. And also we've just recently undertaken a study to extend the train from Dallas to Fort Worth. And eventually we'll extend the train to Austin from our mid station near Texas A&M. So it's there's a long-term vision here that this high-speed rail would cover all of Texas.
And you're currently also involved in Hoover Institution.
Correct. I've recently been named the chairman of the board of the Hoover Institution at Stanford.
Yeah, congratulations. And what's your role there? Like what's for people who don't know, what does Hoover do?
Hoover is a 104-year-old division of Stanford University. It operates independently from the university. There are about 120 academics that do work for Hoover. Everything from, we have senior fellows to visiting fellows, to adjunct fellows, to national security fellows, but a strong group of folks who do policy research. Hoover also has the second largest archive of books and documents in the United States. And they have really important collections, including collections from the Shah of Iran. They have papers from Shanghai Shek's family office. They have the papers from the czar, the last czar in Russia. I mean, the collection of historical documents at Hoover is really second to none. So it's an important place for free market oriented research. It's a wonderful counterbalance to the university and Stanford as well. It provides a unique form of ideological diversity with the university, keeps it more balanced than it would be otherwise.
And as a chairman, your role is to...
Being chairman you can do a lot of different things as chairman. My first job, I think, is to just show up. So I try to show up at as many Hoover events as I can. I also help our director, Condoleezza Rice, manage the overseers at Hoover. So the governance of Hoover is run through the board of overseers, and I'm head of that board, and I help manage those overseers and help them get involved at Hoover from a policy standpoint as much as I can. So I'm not involved in the management of the academic fellows as much as I'm involved in the management of the overseers.
Well, that sounds fascinating though. Like it's those events. I've seen a few of the lectures and stuff online, and those are amazing.
We have some tremendous academics and researchers, and we have a great economics unit with a dozen of the top economists in the country. I think we have 4 economists that have all been chairmen of the Council of Economic Advisors in the White House at one time or another. We've got a great historical group. We've got great political scientists who run programs in cybersecurity and national security for us. I mean, it's a really impressive organization doing great work, and I'm just pleased to be associated with them.
You've participated in the Russian privatization stuff. It's kind of fun experience for you, and just in general was very lucrative. You ran very successful hedge fund. You're now working on that railroad. You're in Hoover Institutions. When are you going to stop? What else you didn't achieve that you're trying to?
I don't have a list of things that I want to achieve. It's more of a process of staying relevant. You want to stay involved. You want to stay active. You want to do things that are meaningful and that engage your brain and allow you to work with high quality people. And I don't know the answer to your question. I think I'm just going to keep on keeping on.
And if there is new interesting project, you're basically taking on.
My wife accuses me of saying yes too often, and you have to say no. There's so many things to do, either in business or in the philanthropic side, so you have to be selective. But I hope I'm still saying yes 10 years from now, 20 years from now. I won't be saying yes as often, but I hope I'm still saying yes.
Well, I hope so too. And John, thanks very much for being on the podcast. It was great. I really enjoyed it.
Really, thank you so much for having me. I really enjoyed the conversation. Thank you.